All right, good evening, everyone. Welcome to the Hurley Investments Trade Finding and Adjustments for Tuesday night, the 26th of January. Last Thursday or last Tuesday? I can't remember when it was. It might have been Monday. But the last time I tried to give a trade finding adjustment, I talked about General Electric and I talked about General Motors. And General Electric knocked it out of the park. They basically are going to have free cash flow that they haven't had in a while. Every reason that I thought they would come and have great earnings, that was not the reason why they had great earnings. It has nothing to do with motors. It has nothing to do with Boeing. It actually had everything to do with nothing more than free cash flow. That was it. They were up pretty big during the day, but every reason I wanted you to get into this particular stock basically was the wrong reason. It's not every day that I get to tell you guys that, but the short answer was every reason I wanted you guys into this was the wrong reason. It shouldn't have been that way, and for that reason, I apologize. But the funny thing is, the results are awesome. So Maud asked, wouldn't it be from better sales? Where'd their cash come from? Yes. Now, the interesting part, it was from better sales, but better sales in none of the two areas or three areas that I mentioned, which I thought was hilarious. They missed their earnings per share. They missed it. They missed it by a penny. But the revenue came in $100 million better. So the top line came in better than expected. As 2020 progressed, we significantly improved GE's profitability, cash performance, despite a still difficult macro environment. So what they did is they trimmed the fat. They fired people. They got rid of people. They upgraded everything from their proficiencies to making engines to gas turbines. And the real big issue was, hey, we make electric motors that conserve that energy that's created by solar. They're part of the Green New Deal. And because of what's expected down the line, they're going to generate somewhere between $2.5 billion to $4.5 billion free cash flow in the next year. What does that free cash flow mean? It's a simple answer, but what does that free cash flow mean? If you don't know, type a question in, a question mark or two. What does that free cash flow mean? So more profitability. Some people are typing in, they'll upgrade their equipment. They'll have more money for product. All of those are what you would expect. But will someone please tell me what has free cash flow been the last 10 years? Buy back more shares. Bingo. Opportunity to buy more equipment, pay down debt. You guys are all correct. It's what it should be. But Maud wins it. they're going to buy a crap load of their shares back. They're going to take it off the market, and they are going to artificially inflate their stock price, just like everyone else has, because they can stick 1 billion shares to buy back. 1 billion shares at $11. I mean, it's 110 million shares they're going to take off the market. For every billion that they buy back, 110 million shares are coming out of the market. Now, it's GE. Let's face it, GE is a big company. We'll take a quick peek here, and we're going to see, will that truly affect the stock price, right? Will it really move them when their shares that are short are 8.74 billion shares? Not really. It really won't move it a bunch. So Kevin, then why are you telling me this? In fact, that 110 billion shares might only be a half a day worth of tradable shares. Or if you go to the average volume, it might only be a day and a bit of average volume that's traded. Well, it'll spark the short flow race, which really kind of freaks me out. If you're looking at GameStop, if you're looking at what's going on, it's going to create a short flow covering or race to see who can cover their shares as quickly as possible. I've got a 5-minute video. I want you guys to enjoy this quick 5-minute video, and let's hear what you guys able to hear me again? If you can hear me, please let me know. Let's make sure I'm back on track here. All right, I'm back. All I'm going to do is show you a quick 5-minute video on why most short sellers lose money, so you guys can be shocked. But this is what's going to happen to General Electric. We just saw GameStop go from $30 to $250 right now. Don't be surprised to see General Electric go from 11 up to 50 almost overnight. Here's the reason why, though. Please enjoy this 5-minute video.
GameStop's wild ride continues, up again, more than doubling from a week ago. Bob Pisani has a good piece out on CNBC.com saying that short sellers are down 91 billion this month, and GameStop is obviously leading the squeeze. Bob joins us this morning to talk about it. Some staggering figures here, Bob.
Yeah, short sellers have obviously picked the wrong stocks in January, but I think this is an important teaching moment about short sellers in general. The real enemy of short sellers is not the Reddit chat rooms or Robinhood, although that's a problem for them. The real enemy of short selling has been the Federal Reserve and the oceans of liquidity they have been providing, and to a lesser extent, the stimulus in the last year. That has resulted in big losses, but they have been losing money for many, many years. Most short sellers never make money, despite the fact that we have some occasional short selling superstars on. Last year, for example, they lost $243 billion, and in January, as you noted, Carl, $91 billion. So is this a little? Is this a lot? Shorts at any one time are about 2% of the market value. About 2% of the market value is short. So we have a maybe $40 trillion stock market. That's about $1 trillion short. So you lose 240 billion of 1 trillion. That's a 25% loss. That's a pretty bad year for most short sellers. And yet we know that they have a lot of value. They provide a lot of value overall. They provide hedges to long portfolios, and they provide liquidity for equities and those derivative traders that are out there as well, who take the other side of the options trade. So there's a lot of value here, Carl, for those shorts.
Yeah, Bob, it's David. Of course, we always need to remind people who perhaps don't fully understand it, the unlimited downside of shorting stock, right? I mean, when you own a stock, particularly not on leverage, it can only go to zero. But you know, you could have shorted $50 million worth of GameStop and be down 150 million. And that, of course, is what Mr. Plotkin at Melvin is sort of facing in terms of at least their decision to short a great deal of GameStop and then go and get more, amazing story, really, more capital from SAC and Citadel to just continue to be in there and make sure they don't have to cover, which is fascinating.
Yeah. And it makes it's very interesting, because what happens here when you get those kind of blowouts is actually it becomes harder to borrow the stock. So in a way, it puts a lot of pressure on different parts of the market. If you can't borrow it, you're going to go out, maybe try to buy puts or something like that. It'll put pressure on the market. And one of the interesting questions here is what's going to happen with, for example, this 1-2 punch that they have seen, the short sellers have seen, this ocean of liquidity that's made it really difficult to make money. But then at the same time, you have this aggressive buying of out of the money calls that's been occurring. And that's a sort of a 1-2 punch for the short sellers. I think most traders that I talked to said, what's going to happen here? They said call option prices have got to rise a lot more to sort of deal with this entire issue. And even as the shorts cover, there are new shorts coming in. So it's not the death of shorts. And nobody said to me yesterday when I was calling around, said, oh, this is it. The shorts are toast. There were new shorts coming in places like the financial area in the last few days.
It seems to be a new strategy, though. It does seem I wouldn't say new strategy. I mean, I feel like we've seen reminiscence of this even from the late 90s with the Yahoo chat boards, but there does seem to be a new focus on it. I mean, I saw a stat this morning that I think has been vetted. You know, stocks with short interest of more than 5%, and this is from the retail sort of heavy option trades of those stocks, are up 40%. If you have 5% or less in terms of short interest, your stock's barely up this year.
Yeah. So yes. So this is that 1-2 strategy I was mentioning. So you're right. But in a lot of ways, the 90s chat rooms that you and I covered are very much the same, in that it's the same behavioral psychology, the same dopamine that they force off in the brain, the same herd following that you have, the same trend reinforcement, all of these behavioral economics terms is the same, but at the same time, it's very different. Remember when people used to have those old DLJ accounts back then, it was very cumbersome, and it took a while for people to get confirmations, 20 minutes to the next day. This is very different. The technology is very different. It's a lot easier. You're sitting alone or you're sitting with your friends trading stocks on your phone now, instantaneous confirmation. And it's the same thing doing FanDuel at the same time. There's something that's qualitatively different about this compared to the 1990s, even though the psychology, the behavioral economics, the herd mentality is still the same.
You know, Bob, I was watching the action yesterday and Friday. Another difference between these people in the 90s is they're far more sophisticated. Let's give them credit. This strategy of basically buying these out of the money calls and not allowing people really can't be able to hedge is a brand new tactic, and they knew exactly what would happen if they did it. Although yesterday a lot of people lost money because they bought calls at one point for $50 for the 150. So can you talk about the new strategy of really breaking the shorts and the market makers, and then how much money was lost by people who believed that this thing was going to go $200, $300 yesterday?
Yeah, well, the first problem, of course, here is, yes, it's the strategy of buying out of the money calls has been working. But remember something, Jim, this worked in 1999 until March 10th, 2000. Remember that day?
True.
So never confuse an up market with being a genius was a favorite phrase around that time. So I think that's the most important thing to recognize right now, that we're dealing in an up market, guys, and this is going to quickly change strategy as soon as we see any kind of significant down market.
All right, let's get to a mad dash this morning.
All righty. Pretty amazing to see what's happening in our market. So let's see what's happening to our trades. GE, not bad. There's the short and the skinny of where we're at. If you can take a quick peek, if you did the 1017s, you're really in good shape. What you spent for 203 is not really up. I mean, the mark's 208. It was better during the day. If you still want to get into this trade, you're going to spend 5 more cents than I will. But on that push up day, on that day where we have good numbers, the day when it gets back up to $12, you're going to look at this and say, wow, I just went from 208, 203. You're going to go up to, well, probably somewhere in that range of 255, 260. That's where we were in regards to the opportunity that's here. But this is a year-long opportunity. If you were to really pay attention, anything above $12 is where you start to generate a profit on this trade. With that said, nothing like getting into a bunch of General Motors. Short answer is everything that cost us $873 is only worth $735. Anything that may have cost us $1039 is only worth $890. Anything that cost us $7.07 is only worth $6. But we have earnings coming up. And not only that, we still have quite a bit of time this year. I've put that short video right here. Anytime you go short, you have unlimited risk, or you have risk to where you're going to have the possibility of what you thought was a $50 billion trade, or for us, let's be realistic, a $5,000 short could turn into a $25,000 short overnight. Anytime you're shorting, you're obligated to sell the stock at a certain price for a certain period of time. And you're going to get like a 25 or a 35% margin held out. So just because the company's holding out $25,000 doesn't mean you can't lose 75 immediately. Now the stock only goes down to 0, right? But the stock could go up to 1 million. Imagine if you were GameStop today, as you saw there, and you shorted it at $80. It closed today at 160 or 147. A 147 close on GameStop, you have to go buy the stock at $147 and turn around and sell it at 80 or 90, wherever you put your short at. At one point in time, GameStop was up at $225. Could you imagine having a short at $80, having to buy the stock at $225, and then turn around and sell it at $80? That's where it has that unlimited risk. You don't know how high it can go to. 225 minus 80, you lose $145. You lose 1.6% where you thought the stock was going to go down. You don't short or naked short option positions. You don't short or naked short stock positions. That didn't make sense. Let me try that again. You never naked short an option, a commodity, or a stock. The risk is too great. That's what I'm trying to tell you. You never naked short a stock, commodity, option. It's just too risky, especially when options leverage themselves. All right. MasterCard Visa. In all honesty, what a great opportunity it is to get into Visa. I have a huge amount of data on Visa and MasterCard. I'm not going to go over all this. This is your due diligence. You want to know why I'm in Visa? I've got pages after pages of why I'd be in Visa over MasterCard, over Discover, over American Express. There are pages of information here to understand why I would be in Visa. Visa has its earnings on Thursday. If I was going to be in Visa, I'm going to go out to some kind of leap long haul position. My current portfolio is there. Apple, GE, General Motors. There we go. I'm up a whopping $41. If I was looking to put on a trade, I'm going to go Visa. And I've got $125,000 of margin buying power here, 62. I could put on a lot of contracts of Visa. It's not the smartest thing in the world to do. If I was going to go into Visa, 202, I feel like we're going to probably have a pretty good drop in this first quarter. I would look to most likely do the January 2022, the January 2022. I would probably look to buy that leap call. And even though I've got plenty of money in my account, I most likely don't want to spend any more than $1,500. I could do two, but I'm probably planning on dollar cost averaging this 2 or 3 times. This is the trade I would be in. I would be looking at being in a leap long call contract where literally I'm looking to more than double my money. It's an expensive one. I'm going to pay $14.87. My expectation is Visa should be trading about $2.50 by the end of the year. And that's on the low end. My break even on this one, right, is the cost of my option position plus where I have the right to buy it at. My break even is way up at 220 plus the 15 bucks. It's like at 235. Well, Kevin, you're having Visa having to move 15%. Yeah, almost 17 and a half. The break even's at 235 and 15 cents. Why would you do that, Kevin? Well, it comes down to simple numbers again, valuations. They think they have an upside. Where is it? Growth rate, our model shows. I think that's exactly where Visa shows that's average price or where it should be. 235.61. For their model, it should be moving at least up to 235.61 and should do it in a pretty quick time period. If you crunch all your numbers on where you think Visa is going to go, it falls right in line where my break even on this trade would be. But again, most likely it's going to go farther than that. It's going to go faster than that. So if you're looking to be in a trade, the target price of Visa, it's actually right here. I had it right in front of me and I didn't see it. Their target price, my target price, 235.61. If everything just stays on the low side, my trade will be profitable. If it gets there in the first quarter, I'm out. I'm out with a 50, 60, 70, 80, 100% return. If it gets there in the second quarter, then I'm going to stay in till it hits 250 for the 100% return. But it's nothing more than doing a little bit of research and saying, you know what? I'm looking for that opportunity. Even though I could put 10 contracts on, if I'm expecting to possibly have the dollar cost average it 2 or 3 times, yeah, I could afford a $15,000, but I don't want to possibly put another 30 into it. That over leverages a portfolio. A leap long call on Visa is where I'd be looking to go right now. And the neat thing is, if you want to give yourself a little more time, these numbers don't look bad going out to a March. I'm not sure if I might end up going out to a March, but a March 220 is only $18. What's the advantage of paying the extra $3 for 3 more months? Christmas. So I don't know if I'm going to do the other one or this one, but it looks very interesting. It looks like an opportunity to where I'd like to put some money to work. Where's the question here? With earnings so close, wouldn't you want to wait? Actually, no, Maud, I want to go through earnings. And again, I want to go through earnings because it's Christmas. Historically, as you get used to the patterns in your stocks, this should be a great month for Visa. This should be a month that we're looking to Visa and saying, hey, this can really, really run. Going the last 5 years, well, last year we had a drop. That didn't help us out, right? 2019, look at that run on Visa. 2018, look on the run on Visa before it then fell and came back. 2017, look at the run on Visa. 2016, there wasn't a run. 2015, the run took a little while. Same thing with 2016. 2015, excuse me. 2014, it wasn't there. The chart tells me what I'm looking at. And the chart tells me that I want to play that post-Christmas rally. And it typically has been there because people charge the crap out of their cards for Christmas. So, Kevin, aren't you so close to earnings? Aren't you going to pay some huge extrinsic value, some extra value because of the volatility? No, not really. I'm out a year. I'm out a year and 3 months. I'm not doing this on any option that's going to be hit with volatility crush. It's too far out in time to have volatility crush affect this position. So no, I would, Maud, I would do it as soon as you wanted to. Tomorrow, before Thursday's earnings. Any other questions? I hope this was good information. It'll take me a little bit to get this posted, but do listen to that video again. Do spend a little bit of time understanding why naked shorts are so risky. You're obligated to sell the stock at a certain price for a certain period of time, and it's unlimited how high that stock can go. That's why we don't do that at Hurley Investments. It's not safe investing, it's gambling when investors do that. I see no questions coming in. Guys, have a wonderful evening. I appreciate you being here with me tonight. We'll look forward to talking to you Thursday morning, and until then, take care. Bye-bye.